So it's a day of reckoning for Europe's banks. They've been put through their paces to see if they have what it takes to weather a financial storm. And here with me to share their insight are a pair of commentators who've been following these developments very closely. Sanjay Joshi heads up the fixed income team at London and Capital, and Jean-Pierre Lambert is an analyst at Keefe Bruyette Woods. Thanks very much indeed, gentlemen, for joining us. So, Jean-Pierre, if I can start with you. When the stress tests were first announced, there seemed to be a level of optimism that it would bring some transparency to the banking industry as a whole, but now the main issue seems to be that these tests simply won't be stressful enough.
Well, I think there are two dimensions. First, the economic impact of a downturn scenario. I think we can take these stress tests will be very credible. They match, in our expectation, what we have estimated. The question is the sovereign risk, which is a worry for the market. How much disclosure will there be, and what will be the impact? If we look at the trading book, we expect a minimal impact, maybe 40 basis points of Tier 1 gone for the sector on average. So it's quite manageable as well. So overall, we expect most of the bank to pass, and there are just a few names which are borderline, and that's where we will see tonight.
Sanjay, do you agree with that when we look at some of the scenarios that these banks are being tested against, that you've got a fairly realistic assessment of the way these banks will weather an economic downturn? But what about the so-called sovereign shock scenario? What do you make of that?
I think that is the problem, the sovereign debt crisis, the sort of haircuts that we put in for Greek debt, Spanish debt, Portuguese debt. The sort of numbers that have been bandied around between 5 to 20% will certainly make it a positive development going forward. I would suggest the largest banks would be fine on that. I think the problem is some of the regional banks, the Cajas, the Landesbanks, where they will have trouble and they need to raise capital going forward. But generally, I have a very positive view on the European banks and their exposure to sovereign debt crisis.
Jean-Pierre, Sanjay mentioned there some of the Spanish regional banks, and already two newspapers in Spain are reporting that some savings banks in that country could need extra capital. Is there reason to be concerned about this?
Well, the Spanish government has been very forward-looking and has been pressing for the stress tests to be published, so they're taking action, such as organizing the merger of regional cajas. So in some cases, weak plus strong regional banks, and the outcome will be a stronger bank overall on the merger.
So you don't think that the impact of a regional savings bank failing would be very significant?
The government will take action to recapitalize the banks which are borderline on the stress test.
But Sanjay, doesn't that depend on the level of recapitalization that is needed?
Well, that's the problem. That they need to be very clear, just like the US was last year, in terms of the amount of capital that will be required, and will the ECB and the government stand behind the institutions? If we don't get that clarity from Trichet and the European governments, then we could have trouble. But, policymakers are sensible. They must know the ramifications of allowing the Cajas to go under. So I would expect a very potent plan to be announced later on today if capital is required going forward.
Where is that capital going to come from, Jean-Pierre?
Well, if we look at the countries where some of the unlisted entities are borderline and some of the listed one as well, there is capital available. There is capital available for restructuring of Spanish banks. There is capital available at the SOFIN, which is a German institution which deals with such situation. And we have capital available under the IMF facility for the Greek institutions. So these are the three regional ones. And then we have a pan-European one as well, where eventually governments could tap if necessary.
But they'll be forced to go to the markets first, right? The banks.
It's possible that the banks have the choice to go to market, but the non-listed one obviously will not. They will depend on the governments who are shareholders.
Sanjay, these tests are looking at how these banks would fare if the loans that they have on their books would suddenly deteriorate. But at the end of the day, they're based on hypothetical situations, right? So what are the chances that Greece or Spain would have trouble raising the money they need if there is a sudden lack of demand in the marketplace for Greek or Spanish bonds?
I'm less concerned about Spain because I think the Spanish government has announced fairly long-term plans. I think Greece is where you're going to see difficulties going forward, and you may well have to have significant input from the ECB and the IMF. So a full take-up of the plans that have been announced. I think Spain, Portugal should be fine going forward.
Jean-Pierre, how difficult is it for banks to borrow money from the market right now?
Well, there are significant differences. If you take the Greek banks, they receive quite a lot of liquidity injection from the ECB, at meaningful level. Some of the banks are more dependent than others from the ECB, so there is a big variance in this access to funding. But the hope is that these stress tests will pacify the market in general, and unfortunately the market might focus on the league table, which will come out tonight, and the names which are at the bottom with the lowest or weakest Tier 1 ratio after the stress test might be under pressure to take action to raise capital or to address some of the issues.
But Sanjay, again I go back to the crux of the issue, and it's one that we have been coming back to consistently throughout our coverage of this story. That certainly when you look at what investors and analysts have been saying, regardless of what the results show, even if most of the banks pass, the big banks pass, the ones that really matter, at the end of the day, there is a fundamental lack of confidence in the rigorousness of these tests, that you cannot have confidence if you don't have transparency, right?
Yes. For this to be a game changer like it was for the US last year, you need two clear things. Very clear outlook in terms of the balance sheet. So there needs to be transparency. We should know everything that's on the balance sheet. And secondly, the stress test should be fairly significant so that we know whether it's going to have a major impact in terms of the Tier 1 ratios going forward. If that all comes through, that will certainly pacify me.
Right, so Jean-Pierre, in just literally 5 seconds, what is the likelihood that these tests will ultimately fulfill their objective, restore some confidence, if not remove doubts, in Europe's banks?
I think the likelihood is fairly high that it will instill some further confidence, and it will identify the institutions which are borderline, and action will be taken. Okay,
Jean-Pierre Lambert, analyst at Keefe Bruyette Woods, and Sanjay Joshi, thank you so much for your time, guys. Thank you.